Hello students, welcome to the series on business environment. The topic of this lecture is fiscal policy. This lecture is in continuation with the last lecture. In the last lecture, we had discussed the meaning and definition of fiscal policy given by various authors. We also discussed the need, significance and objectives of the fiscal policy in the last lecture. In this lecture, we will discuss taxation as an important source of public revenue. As discussed in the last lecture, taxation and public borrowings are the important sources of public revenue for the government. The success of developmental programs by the government depends entirely upon the economic and administrative capacity of the tax system. The objectives of taxation are transferring resources from the hands of public to the hands of state to make possible public investment, restraining or curtailing the consumption and thus transferring resources from consumption to investment, increasing the incentives to save and invest, modifying the pattern of investment and mitigating the economic inequalities. In the developing countries, as and when the requirement for development increases, the government tries to raise the rates of existing taxes and imposes new taxes. Taxation plays a significant role in curbing consumption. Through direct taxes, the government reduces the disposable income in the hands of people and thus restricts their capacity to buy goods. Through indirect taxes, the government raises the prices of the goods to restrict consumption. If funds raised through imposing of taxes are loaned either to the private sector for carrying out investment or utilized directly by the government for building up public enterprises or developing social overhead capital, the process of capital formation and economic development gets a boost. Regarding encouraging saving and investment, the taxation policy adopts a number of measures such as encouraging the habit of savings and granting income tax concessions on the money saved. Similar concessions are also granted on the savings of firms and other institutions. To encourage investment, tax rebates, tax holidays to business enterprises in their initial years of operation and depreciation allowances etc. are granted by the Indian government. As highlighted by Heller, the danger is that tax concessions are likely to be converted into tax loopholes. Taxpayers are ever watchful to gain tax benefits by meeting the formal requirement of the concession provisions without carrying out the underlying intent. Among the structural improvements and incentive devices most widely supported in the field of business income taxation are the allowance of extensive carryovers of net business losses in 1 year as offsets against net business gains in other years. This reduces or removes the deterrent to investment that otherwise results from the lack of opportunity to deduct business outlays in full form income subject to taxation. Accelerated depreciation, permitting the more rapid recapture of productive investment. This device has the effect of giving the investor an interest-free loan from the government. Preferential rates for reinvested business profits or alternatively additional taxes on profits declared as dividends. This measure recognizes such profits as primary source of investment funds and seeks to discourage this dissipation in consumption or their loss by transfer abroad. Taxation can be used as a tool for modifying the pattern of investment. This objective can be accomplished by encouraging investment in desired lines of production through tax incentive and by restricting investment in unproductive channels by penalizing such investment through a high level of taxation. Unproductive channels include speculation activities, investment in real estate, land, property, etc. The government can use its tax policy to discourage such activities. If the government feels that investment in basic and capital goods industry is necessary for pushing up the rate of industrialization, it can set up these industries in the public sector, and for this purpose, resources obtained through taxation can be utilized. Mitigating economic inequalities relate to redistributive aspects of the fiscal policy. According to Heller, investments in human beings are an integral part of government programs for improving productivity and technology. Improvements in sanitation, health, and nutrition help in increasing the working capacity of the people, leading to an improvement in the quality of manpower available for economic development. Programs of education and training reduce the illiteracy and increase skills, leading to an increase in the quality of the manpower. To the extent the taxation finances this process of human capital formation at the expense of lavish consumption, speculation, and foreign exchange hoarding rather than at the expense of productive private investment, it increases productivity and accelerates the development. Redistributive government finance can be utilized to increase the productivity and real income of the bulk of the population. Not only this redistributive finance helps in reducing political instability by helping in reducing the gap between the rich and the poor, because extreme inequality in income and wealth leads to political instability. Let us now discuss the use of different taxes in generation of resources. These different taxes are personal income tax, corporate income tax, excise duty, sales tax, custom duties, expenditure tax, and tax on agriculture. Let us discuss the personal income tax in detail. India depends on income tax to a far lesser extent than the developed countries. The reason behind this is that a large proportion of the people have no capacity to pay income tax, and hence they have to be exempted, while other people have low income levels and their ability to pay income tax is limited. Because of general administrative weakness in the collection of income taxes, there is a widespread problem of tax evasion. In India, a substantial proportion of money income is concentrated in the hands of small minority. Therefore, considerable scope exists for enlarging the revenue from income tax by tapping this source more effectively. Indian government often argue that a rise in taxes on the highest income group is likely to have an adverse effect on their ability and willingness to invest, but the fact is that they have vested interest in not attempting to increase the tax rates. It may be because the government have some tacit understanding with the big businessmen in India. The other type of tax is the corporate income tax. The share of corporate income taxes in total revenue is much less in India as compared to the developed countries. This is because the corporate sector is only a small part of the Indian economy. So, the contribution of this sector in total income of the Indian government is bound to be low. The other reason is in a bid to encourage corporate activity, the Government of India offer a wide range of incentive to the companies. These incentives take the form of depreciation allowance, tax rebate, investment subsidy, etc. Yet another reason is that high corporate income taxes are likely to discourage the formation of new companies. So, the government avoid taxing the corporate sector heavily. Despite these limitations, it is to be noted that such taxes are easy to collect since the number of companies is small in India and can be easily identified. Many of the multinational companies operating in India are large and earn huge profits. In return of repatriation of these profits, government can demand a certain portion in the form of taxes, but usually the foreign companies are exempted from heavy taxes, so that the incentive to promote the foreign investors remain. Yet another type of tax is the property tax. As mentioned earlier that in India, extreme inequalities of income and wealth exists. So, the property taxes are used to take the resources from the rich class of the society, and because of this, the revenue resources of the government increases in India. Such taxes do not have adverse effect on the incentive to invest, since they are not levied on the production activities of the people. Also, the inequalities can be substantially reduced through such taxes. Despite all these advantages, the property taxes do not contribute much to the public revenue in India. The other type of tax is the excise duties. It is important to note here that the personal income tax, corporate income tax and property tax are the direct taxes, whereas the excise duties is the indirect tax. India depends largely on the excise duty, as it is the source of revenue to make the tax structure progressive. Excise duties increase the regressivity of the tax system, as all the persons who consume the commodity on which tax is levied must pay the tax whether they are rich or poor. Some progressivity can be introduced in the tax system by taxing luxury goods and at the higher rate and mass consumption goods at a lower rate. But this practice often fails to produce the desired results, as the demand for the luxury goods is elastic while the demand for the mass consumption goods is inelastic. An increase in the price of the luxury goods decreases their demand, but the demand of the mass consumption goods remains stationary consequent upon the sharp change or sharp increase in the price. So, the government depends more on the excise duties on mass consumption goods. Another type of indirect tax is the sales tax. While excise duty is levied on production, the sales tax is levied at the moment of the actual sale of the commodity. Therefore, sales tax is essentially a tax on business transactions. It is collected from all registered trading concerns who invariably shift their burden to the customers. The sales tax can be introduced at any of the three stages, and these three stages are the manufacturing stage, the wholesale stage, and the retail stage. In India, sales tax is introduced at the retail stage. It is difficult to administer the retail stage taxation since a large number of small retail traders are operating in India. And it is difficult to maintain contact with all of them because most of them are illiterate and have no accounting knowledge. So, it is impractical to consider such taxation in a large area like India. Another type of tax or the indirect tax is the custom duties. Tax on goods entering the foreign trade come under this category. The two types of duties are import duties and export duties. Custom duties are an important source of collecting tax revenue, especially the import duties. This is because the export of these countries are very low and it is frequently very difficult to increase them because of the unfavorable conditions in the international markets and consumer prejudices against goods of poor countries. Another reason is that it is necessary to protect the domestic industries against the foreign competition by making the imported goods relatively more expensive than the domestically produced goods. In India, ambitious programs of industrializations are undertaken, and for this purpose, huge imports of capital goods and machinery are essential. So, import duties on such goods is low as compared to the import duties on the luxury items. Generally, the number of goods imported by a country are limited, and the number of ports through which these goods enter the country are limited. Also, the goods arrive in bulk containers and cannot escape detection. This is the advantage of the import duties, and this helps in collecting the revenue easily. But there is a tendency to grant subsidies to export in a bid to make them competitive in the international markets. The other type of indirect tax is the expenditure tax. It is imposed on the actual expenditure, which is personal income minus savings, done by an individual. This tax does not affect the savings adversely like the income tax. But the administrative cost of levying the expenditure tax is heavy. The Government of India introduced this tax in the year 1957 but later withdrew it. The last type of indirect tax is the tax on agriculture. It is a paradox in India that while the agriculture sector provides employment to the majority proportion of the total population of India, and while the agriculture sector contributes a high proportion of the total national product, agriculture itself either goes tax free or should be taxed lightly. But agriculture is the subsistence sector of the Indian economy, and therefore it is not in a position to bear the tax burden. This is true for the large section of rural population, but it is not correct when applied to the large landowners who possess huge resources. But the failure to tax these people renders the Indian tax system unjust. The position of the poor people in rural areas in India as well as the urban areas in India is same, as in both the areas they are required to bear heavy commodity taxes. But the position of the rural poor in India is worse as their levels of income are lower than those of the urban poor in many regions of India. Agriculture can be taxed in various ways, and these various ways are land taxation, agriculture income tax, taxation of agriculture produce, etc. Land taxation is the oldest form of agriculture taxation and it is also known as land revenue. To introduce progression in the land revenue, attempts are made to exempt the land revenue on small holdings and impose surcharges and special charges on the land revenue payable by holdings above a certain size. Despite this element of progression, the large landowners still contribute a small portion of their income as land revenue. So, the difference made by such measures go negligible. Difficulties in administering land taxes arises because there is no clearly defined pattern of land ownership in India. Most of the cultivators are mere tenants having only the right to cultivate rather than to own the land. If the government exercises an effective control over the marketing system, it can think in terms of imposing taxes on the agriculture produce. For example, it can purchase the crop from the farmers and pay the price net of tax. The actual tax can then be later collected from the persons, whether wholesalers or intermediaries, who purchase the crop from the government. But this type of tax is also difficult to collect on account of the administrative problems. Many economists advocate that there should be a tax on agriculture income in the same way as there is tax on other incomes. For this purpose, the local tax authorities can first draw up a list of main sources of income and wealth in an area like in crops, cattle, trading, transport, wages, salaries, etc. And then calculations can be made of the taxable capacity of the different types of incomes or income yielding assets. These can then be aggregated to obtain the estimates of total income and wealth. This income can form the basis of levying agriculture income tax. The advantage of this type of tax is that it is an effective means of reaching the people with incomes below the exemption limit of a proper income tax. Since it is based on the estimate of an individual's taxable capacity rather than only his money income, it can take account of factors that influence taxable capacity such as the possession of assets and the consumption of non-marketed produce. Let us discuss some of the problems of raising resources through taxation in India. These problems are: there is a large non-monetized sector in India. It is difficult to access the income originating in this sector. Even the highly skilled tax administrators find it difficult to access the income of the farmers and other self-employed people in India. This also includes the evaluation of the value of home produced and consumed food in the taxable income of the farmers. Another reason is the majority of the population in India is illiterate. Most of the farmers, wage earners, shopkeepers, craftsmen, etc. cannot even fill the simple income tax form. The key to successful income tax is voluntary compliance on the part of the taxpayers. However, this condition is sadly wanting in India. The large number of businessmen in India do not even maintain their books of accounts. While some do keep the books of accounts but keep one or more sets, and which is very confusing. In such condition, it is not possible to levy the income tax judiciously. While fixed income group or the salaried class in India pay income tax regularly, a large number of prosperous businessmen either go scot-free or pay only a very small part of their income as tax. According to Calder, in a large number of developing countries, there is no single comprehensive tax on all income, but the so-called schedular system of income taxation is in use. This system has administrative advantages, but while it imposes separate taxes on different sources of income, it leaves many important sources entirely untaxed. Anonymity in the ownership of wealth is another serious problem in India. This may be in the form of bearer shares in the case of companies or the system of Benami in India. This is a legal loophole which makes it difficult to tax income derived from the capital or wealth in an effective manner. As stated earlier in this lecture, the largest sector in India is the agriculture sector. However, this is mostly exempt from taxation or the tax is lightly imposed. Thus, a disproportionate share of the burden of taxation has to be borne by the small monetized or market sector. Corruption is yet another problem in India, and people even go for tax evasion. So, this was about taxation as the source of collecting public revenue by the Indian government. In the next lecture, we will discuss the public borrowings as a part of fiscal policy. Thank you.